So today we will be learning the essential of option trading. So in this I will be taking you one of the well-known concept, delta neutral trading. Delta neutral approach we will learn. It is one of the basic concept, very basic concept of option strategic trade, and it can protect you in many ways. But the steps whatever I will mention, I'll request all of you to follow those steps so that it will benefit you. Before going to those delta neutral approach, let me explain the intraday trade in the option. Though option is a hedging instrument, option must not be considered as a trading instrument. It is a hedging instrument. If you have futures, you can protect it with the help of options. If you want your money should be protected, and if you want one calculated risk must be taken in your trading portfolio, then you can make use of option. However, you can use the same concept of trading in the options. However, many people what they used to do while trading in the options, especially for the intraday, by ignorance, they are using directly the Fibonacci ratio. They are using some of the technical indicators on the option price. So that is a wrong way to estimate the option premium, and that is a blunder I can say. So option is a derived instrument. It is not a direct instrument. It is being derived from one underlying asset. Hence, it will not obey the technical parameters. Rather, it will follow its pricing behavior, the pricing models. Rather, it will follow its Greeks. Rather, it will follow the volatility phenomena. So these are the things differentiate option from other instrument. So here, while doing the intraday trade in the options, what are the tasks we need to do? Identify the correct strike, choose whether to trade in call option or put option, and we need to identify the entry price and identify the profit targets. So these are the things we have to do step by step. Correct strike, then we have to make a choice whether to trade in call option or put option. Then we need to know where we should enter the trade. If you are going to buy a call option or sell a call option, at what price we should buy or sell it, and what will be our stop loss for that. So all these things we are going to do in a more scientific way. So as most of you, those who are the old participants, many of you are the old participants, most of you will be knowing that Smart Finance is a company which gives you a lot of resource on the options. We are the company which provides you multiple free to use option calculators, though it is for the demo purpose. So those calculators won't give you 100% result, or its efficiency is just restricted to 25 to 30%, because it is being developed to demonstrate our concept. It is not being developed to help you in the sophisticated trade. So like if you go to our website, you will get intraday Nifty and stock option trade calculator. You will get intraday currency option trade calculator. Like this, you will get one interface, and all these tools are binomial. They use the binomial option pricing model, and based on that model, it will tell you whatever the call option or put option you are choosing, what will be its buying price, what level of underlying asset price movement you should purchase this call option, what will be the stop loss, and what will be the targets. Similar way, we have specific paid tools also, which I will be demonstrating during this program. we have an intraday option trading calculator, which is quite different from the free version what you are seeing in our website. Free version maintains a accuracy level up to 50%. However, this maintains a great accuracy, which I will demonstrate today also. So here, the time you are reporting in the market, if you are early in the morning, then you should take the previous day high, low and last traded price. At least 15-minute gap you have to give. So 9:15 to 9:30 time frame you have to give at least the market to settle down at a particular price, or the price of the underlying asset must be settled down to a specific level. So minimum 15-minute gap you can give. Maximum there is no limit. You give the previous day's high, low and last traded price. You give the trailing 15 minutes high, low, open and price. Suppose if you are reporting by 1 o'clock or 2 o'clock, this is 2 p.m. I am talking about. This is noon. So here previous day is irrelevant for you. That morning action is being gone. It is already factored. It has gone. Henceforth, in the previous day's price, you have to take 9:15 to 2 o'clock. What are the prices? And you have to take the trailing 15 minutes price range. Based on that, you have to analyze the future. Initially, you have to analyze the future. Then you have to analyze the options. I'll demonstrate with one example. I'll just demonstrate it with one example. Today, I have done 3 trades. My first trade, I sold some 250 quantities of 6,000 call option of Nifty. I covered it with 43.35. You will be getting my trade time 9:17 early in the morning, just 2 minutes after the market opens. I sold it off, and around 1:43 I closed this trade. Some 2 rupees, almost 2 rupees, means around 3 rupees and something per lot I will be making. Same way, I have also done one currency option trade, 56 put option. I sold fast, 9 o'clock 3 minutes. In the opening trade itself, I sold it off at 1 rupee and 48 paisa, and 1 rupee 32 I have covered it off. I sold fast, buy next. Similar way, one more trade I have initiated in the State Bank of India, that is around 1 o'clock 40 minutes. I bought the 2250 call option and I covered it off at 53.10, and almost some 600 rupees I made here, some 700 to 700 plus I made here, and some 1600 rupees I have made, because here I have entered 10 lots. So for lot, almost you can say 16 paisa, 160 rupees per lot I made in the currency options. So all these trades are done based on this principle: identifying a correct strike, choose whether to trade in call option or put option, identifying the entry price and profit target. So due to lack of time, I may not be able to analyze all the trades for you. But one trade of the State Bank of India, let me explain it. So it was, just to see for the trade, it is around 137 time frame I have entered to this trade. So during that period of time, during that particular time, means close near to that particular time, I got the State Bank of India's price as follows. I have ignored the previous day high, low and last traded price because I am almost at 140 time. So previous day is not important for me now. So I have taken that current day's high, which was that particular time around 2215, current day's low, and current day's price was 2200. And the same values I have put here, because I am not going to do any trade in the future. Rather, I just analyze the future, and based on that I will be taking an option call. Today's opening, low, high, and the current price. This is in fact the trailing 15 minute I have taken. So around 140 time, trailing 15-minute. It is for intraday I am going to trade. It is for the intraday option trading tool of this integrated tool what I have shown you, same thing I have. It is telling me if the underlying asset, this is future prices, I am taking all future prices, this is not spot or the equity segments is SBI, this is future SBI. So this says if the SBI goes above 2,208 rupees and 50 paisa, then my trend will be up. If it fall down below 2192, then my trend will be down. Currently I am at 2,202 current price. So if I can factor this with the underlying price here, uptrend price, I am just 6 rupees and 50 paisa distanced from the uptrend price. However, if I can factor it here, round it to 91. So 9 to 11 rupees I am above the downtrend price. I repeat, I am 11 rupees above the downtrend price. I am 6 rupees down from the uptrend price. So I am close near to the uptrend price. I am little bit far or almost double the distance I have to fall to trigger this downtrend price. Now you use your logical thinking in this process. I am 6 rupees away from the uptrend. I am 11 rupees away from the downtrend. So this says I have a greater probability to enter to the uptrend price trade. If anyone has any query at this point, you can ask me. Many of you are the buyer of this tool. Many of you are the buyer of this tool. So if anyone has any query, you can ask me now. I am 11 rupees away from the downtrend. I am 6 rupees 50 paisa away from the uptrend. So I have the greater probability to go in the uptrend. I have the greater chances to, it is on the market direct price I am taking. Currently I am 2,202. If someone is asking me what is the chances or whether I should be, whether this price is indicative for a uptrend or a downtrend, what will be my answer? I can just compare this thing. After analyzing the future, I compare this price. I am 6 rupees 50 paisa away from the uptrend. I am 11 rupees away from the downtrend. So I have a greater probability to move in the uptrend. So if I am close near to the downtrend price, then also I can say that yes, I can, if it is close near to, you can say if it is instead of 2202, if I will be near about 2198, then my perception will change. So I am 10 rupees away from the uptrend. I am 7 rupees, almost 7 rupees away from the downtrend. Then I can say that yes, I have a chances to move in the downtrend. So here it's a chances. It never gives you guarantee, warranty, anything. Do not use this term of guarantee, warranty, everything. So this term I have not used. I have used the chances. Yes, I am close near to 2,208. Hence, I assume or I presume, yes, I may enter into the uptrend. I may not also. I may come in the downtrend also. However, nothing wrong if I can say, if it is in the middle of the trend, then you cannot decide. So you cannot decide. If it is middle of this thing, maintaining some 5 rupees distance from here and 5 rupees distance from here, or maintaining a equal distance from the uptrend price and downtrend price, then you have to wait for some more time. Let it give some breakout. Yes, it has given some breakout. Once this, I am getting that the current, it is, I am assuming it is going to enter to the uptrend. Price point, I have entered 49 rupees. Strike price I have taken. If it is going for uptrend, then my assumption will go for, I will be buying a call option. 24 days are left till expiry, excluding today. So today's date will not be considered. So today 27th will be expiring. Today is 3. So 3 minus 24 days are left till expiry, and I have taken the 2250 call option. I could have taken 2200 also, nothing wrong in that. Just I have taken one step ahead, 2250. I could have taken 2200 call option also. So 2250 call option, at that particular junction it was quoting at 49 rupees. This says if I wish to purchase this call option, I must buy at 52, keep a stop loss at 45, and the targets 54, 56, 57, 60 and 69 optimum you can get. And if the downside triggers, then it has the chances to fall down to 32 rupees. So since I was close near to the uptrend price, I have decided to buy at, though my buying has happened at 48, so 48, and in fact I have closed the trade at 53. This is a trailing stop loss as triggered for me, because I have put it trailing at 53, and I was expecting till 56. However, the trailing has triggered for me, and if you can see, this is the 52, 54, 56, like this way it was going on. It has crossed 54. I was expecting 56. However, this is 53 level. I have. You can enter at any time. I have entered 3 things in the 3 different time frame. So 3 trades I have entered in 3 different time frame. 2 trades I have entered, one at 9 o'clock 3 minutes. Second 9:17, it's the opening market I have entered. This is in the noon market I have entered. Purely on the noon time I have entered. Trailing has triggered. I was expecting 56. However, I did not get it. 48. Why I have bought it? Why not at 52? Why I have not waited till 52? Reason, I was close near to the uptrend price. I thought that it will let me buy, put a stop loss at 45. If it triggers, stop loss triggers, then definitely I will come out from this trade, provided the underlying asset should fall below 2191. If it goes in the uptrend, then definitely I will make some profit. So with that objective, I have entered the trade and I have exited the trade. If anyone has any question, can ask me. So identifying a correct strike, uptrend, I have identified, yes, current price is signaling me for a uptrend. Henceforth, I have chosen the call option. I could have chosen 2200 call option also. Whenever once, so one good question is coming from Manish. He is asking, when do you put the 1 hour data in the previous day's input? This is the thing he is giving. When we should put this one. So till 11 o'clock you can make use of the, or till first 1 hour, 9:15 your market opens, till 10:15 you can make use of the previous day's data. Once you cross above that 10:15 time, better use the current day's data. So Sunil R. Naik is saying that advantage in this is early entry and stop loss is, if stop loss is triggers, and Sunil R. Naik is saying that advantage is if early entry and lesser the stop loss, means stop loss trigger, it is lesser only. This 53.1 I have not derived. He said that how do you derive this 53.10? I have put in fact 53, some 10 paisa they used to put some laggings in that, so 10 paisa above it got triggered. I have chosen SBI, Mr. Manoj Jain. You can choose Nifty, you can choose, I have not chosen only SBI. I have explained the SBI. I have told you that I cannot explain all the trades. I have also entered in the Nifty 6000 call option. I have also entered in a currency option. So State Bank of India I have explained. Just I have explained that. Yes, you must come out. You must come out. If stop loss triggers, you must come out. And if you are a swing trader, you may think of selling that call option also. Cost of the trade is, for me, it is 9 to 10 rupees per lot. For you, it may vary. Mr. Ramkumar is saying that what will be the cost of this trade? Cost of the trade may vary. It is 9 to 10 rupees per lot for me. It may vary for you. So it is economical for me because it is, I am paying less brokerage. And many brokers are offering that. So nowadays nobody pays 100, 200 rupees per lot. Yes, Mr. Rohit Gowda, it works in all type of strikes. Strike is not important here. However, deep out of money options, it will not work. Deep out of money options. Same way I have used the integrated tools currency option calculator, and I have initiated that trade. In fact, I have kept a stop loss around 1 rupees and 76 paisa, around that it was there. And in fact, in the State Bank of India, if you'll see, let me see, I think we have around 56 level we have touched today. The options has touched around 56 level, 2250. In fact, it has closed at 56.45. It has touched the day's high 56.45 and settled at 56 and all. So my trailing has triggered. If I would have not put that trailing, I must have got 54 or odd. The second target I must have got. Early entry I have made. "15-minute data you can take from the NSE, you can take from your trading terminal, whichever is feasible for you, you can take from that. Here implied volatility is 28%, underlying asset volatility is 29%, so it is in the 30% band. If this implied volatility will be lesser by 30% or more by 30%, then I should not have entered this trade. You have to enter all this information, then only this tool can analyze for you. Automatically it won't do because it doesn't have a data support. It doesn't have a data support. So fine. So these 8 different varieties of products comes with books, DVDs and software form. Integrated tool, this is our pure software which comes with a user manual, and this is a tool. It has 18 interfaces inside it for intraday trades, for positional trades, for option in-depth analysis, for currency options, everything it has, and the price tag of each product is given here. And all these stuffs, if someone is buying separately one by one, it costs 18,250. At a discounted price, it is offered at 9,750. We have outlets at Mumbai, Gujarat, AP, Hyderabad, Andhra Pradesh, Hyderabad. Recently, we have opened up there, and Chennai. And their contact information of those associates are given here. So our associates' phone numbers are given here. If you wish to, you can take down their phone number and you can make a call to them and take the advantage of the product. And we do conduct specific paid events, seminar events. Our coming event is the forthcoming event is happening on the 5th, 6th, 7th of December. It's an online event. Offline event is in Chennai. It is already over. Due to lack of time, I have cancelled the Mumbai and Gujarat event, and The event details are given here. Phase 1, whatever you will get, phase 2, phase 3, whatever you will get. 1 month support is there. If you wish to, you can enroll for these events also. So regarding the products, services, you can better call to our associates and talk to them. Fine. I'll just go to the next part of our learning, which is delta neutral trading. Most of you will be knowing this trading strategy. Most of you would have heard about this thing. Yes, there is a delta neutral strategy was there. Yes, you can able to calculate all these things. Option Greeks and other things, the software will calculate. You cannot able to calculate, Mr. Ram Kumar. So the software will take some information and it will calculate for this. Any kind of options you can use, Mr. Gary Kaka, for this. Any kind of options, as long as that options is plain vanilla options, it can be used. So automatically our tool will give you the information about the option Greeks. So I will demonstrate one. So after this demonstration, you may get some clear picture about this thing, the tool. So here, delta neutral trading we are going to do. So what is delta neutral means? So first we have to understand delta. So delta of an option represents the change in the option price with respect to change in the underlying asset price. That is what delta says. So the relative change in the underlying asset price. So if you are talking about if I am saying 5,900 call option of Nifty is having a delta of 0.25. So this means, and currently Nifty is at 5,916. If Nifty is at 5916 and the 5,900 call option is having a delta of 0.25. This says if Nifty will go up by 1%, my call option will appreciate by 25%. Same way, if the Nifty will fall down by 1%, then my call option will also depreciate by 25%. This is what delta says. So anyway, once you are paying the premium, so premium is having a relatively greater risk as compared to the underlying asset. So this is what the delta says. And delta has a formula. Delta has many technical aspects, names, its derivations, theories. So those are the things I am not covering now. I am not going to take those theoretical aspects also. So we are going to form strategy. On the strategy point of view only I will be talking. So delta of a future is always 1. Call option delta, it varies from 0 to plus 1. For deep out of money call option, it will be near 0. For deep in the money, it will be plus 1. For put option, it changes from 0 to minus 1. So this is the delta's value, delta's scale, or this you can say the oscillator of the delta. Delta of a future is 1, call option is 0 to plus 1, put option is 0 to minus 1. So here, what does this delta neutral means? This says that reducing the decay risk, reducing the delta risk to a comfort level. So if someone saying that, yes, you buy a call option which is having a delta 0.25, I will not agree. I will not take that thing into granted. I will say that why to take this much of risk, because 25%, 30% the depreciation will be there, and that depreciation will land me in a great loss. So 1% movement in the price is having a 25% of risk. So this is not advisable. So for that reason, I will say that okay, let me reduce this risk. Neutral doesn't mean 0. Neutral means you have to reduce this 25% risk to 5%, 3%, 2%. This is based on your requirement. This is not any other person's requirement. How much risk you can able to carry on your portfolio, that much risk you should be exposed. So that is what called delta neutral. you have to delta neutral, means reducing the delta risk to a comfort level of yours. So delta neutral, whenever we are forming, we should form with the trend positive, trend negative or trend neutral approach. This must be kept in mind. So whenever any strategy we are forming, we must be forming with respect to specific objective. So here objective is, it must be neutral, means your risk must be reduced, but it must be taken with a trend positive, trend negative or trend neutral approach. This should be your delta of 0.4 means 0.40 means 40% risk. Each 1% rise in the underlying asset will appreciate the option by 40%. Each 1% depreciation also will reduce the option value by 40%. So here, this is a question asked by some of our participants. So here, the delta neutral means we are going to form this strategy for the trend positive, trend negative or trend neutral approach. So whenever we are forming this strategy in a trend positive, so the net delta must be kept positive. And whenever we are forming this thing for a negative, the net delta must be kept as negative. And whenever we are forming with the trend neutral, the net delta must be kept near zero. So net delta, we will be buying specific option, selling some specific option. By this process, we will derive a net delta. So that net delta should be positive if the trend is positive. If the trend is negative, then it should be taken, net delta should be negative. In a trend neutral approach, this net delta should be near zero. And in this kind of delta neutral approach, whenever we are reducing this delta risk, so we should aim for a minimum gain of 3%, means each 1% capital appreciation in the underlying asset, we should gain 3%. Or each 1% depreciation also we should lose 3% on our risk capital. So it is not the net capital, on our risk capital, and it must be kept below 30% always. So you can say if 3 events is a failure, then only your entire capital will go off. So maximum 30% you should allow, not more than that. So let me analyze one trade and do accordingly. So here I have delta neutral trading. I have explained you what are the rules. So what are the things we have to do? Analyze the Nifty. We are going to form a Nifty delta neutral strategy for the month of December. Analyze the Nifty price trend, analyze the volatility condition in the Nifty and form the delta neutral strategy as per the volatility and price trend. So here what are the things I have to do? So first is the price trend. So I will be just taking the help of W.D. Gans method. So he has told, in closing basis, if the price close above the 45-degree resistance, then we conclude the trend is up, and trend is up, and this must be validated for 3 days. Trade for 3 days to confirm that trend. So in the close, and vice versa. So this is what the W.D. Gann has told. So what I have done here, I have taken the prices here. So past 3 days price, I have not initiated any trade till date. I will be analyzing the prices now, past 3 days price on the closing basis. What are the prices it has shown me? So based on that I will be deciding. So 29th November, I have the price as 5869.4. This is the price I have closed. So as per the Gans method, I will be taking. So I will be taking first the square root. So here also you will learn the Gans method. I have taken the square root of this number. I have added this number with 45-degree trend line. So it is 0.25 is the degree factor. 45 degree is representing 0.25. Then I will take the whole square of this number. This says 29th closing was 5869. 5869.4. So by this says if it close on the 30th November, if it close above 5907.7, then I confirm this is an uptrend. Yes, it has closed at 5907 above. So this is, or I can start the reading from 27, so it will be better. So 27, my prices was 27 5769 5769.3. So that means on the 29th, 28th we do not have a trading day. So 29th, if price close above 5807, I will be saying that yes, trend is up. Yes, this is a uptrend day. So the first day is got validated. So this is a uptrend. This confirm me uptrend. I am not entering the trade. I am just testing it. Second, I have tested with 5869, 5869.4. This says that if on 30th November it is closing above 5908, then it is a uptrend. So this also classified to be uptrend. Then I'll be taking with 5909. So 5909.1. So this says if it close above 5947.60, then only it will be uptrend. However, this has not, this failed. 2 days it has given me the triggering the yes, the price is in the uptrend. However, third day it has failed. But if I can take the opposite thing, means the 45-degree support, means the vice versa condition, if I am taking square root of this number. So let me take the square root of this number. So 45-degree support, let me see whether I have entered to the downtrend. So this minus 0.25, GAN literature is available in our website. You can read it through it. So into this one, or you can take the full square. If it is falling below 5870, then I can say that yes, the trend has failed. So here I cannot say that this is a failed trend signal. Rather, I can say that it is a consolidation. Though the trend has not given me the signal for uptrend, however, it has also not entered to the downtrend price range. Henceforth, I cannot classify it as a downtrend has changed. Rather, I can say it is a consolidation day. So 2 days out of 3, 2 days was the uptrend. One is a consolidation day. So with this, I have concluded that yes, my price is in the uptrend price range. Let me go for the volatility condition. So for volatility, much works I will not do. I'll just look into what are the Nifty's volatility here. So I'll be just taking the Nifty. So Nifty from NSE site, I'll just take some reference for the Nifty. So from NSE site, I'll just take some reference for the Nifty. I have corrected this. So I have taken the Nifty here. So let me take some reference for the Nifty. So here it is telling me annual volatility is in the 16% band. So it is 16%. So it is a low volatile market. So I have again given you some clue about the volatility. If it is less than 20 in annual terms is low volatile. Greater than 20, less than 40 is medium, and above 40 it is high annual term. So we are in the low volatile market now, and currently Nifty future, which we have taken the reading, which is quoting at 5911.6. So 5911. So uptrend and consolidation day has happened. However, trend has not changed, and we have a low volatility market scenario. So now I'll apply my logical sense here. So I have a low volatile market. Just I'll do the study from here. Low volatile market. From here, where I should go? Either I should be in the low, maintain low, or I can go to medium to high. Medium to high. This is the probability. Either this current scenario will persist, or I will move to the medium to high. This is what is going to happen. Beyond these three conditions, does any other condition is possible? Low volatility will maintain, or the volatility scenario should change to medium to high. This is the probability I have. So if the volatility changes to medium to high, lower to lower, where it will go, Mr. Parun? It is not going to zero. So volatility will never become zero. So do not make the fun of this thing. So it will be low, will maintain. Lower to lower, it is not going to negative volatility. Volatility should not be negative. So here, so low volatility will maintain low, or it will go to the medium to high. Once, if it is maintaining low, what will happen? The time value will fall. Time value I am mentioning as a T will fall. If it is going to medium to high, time value will decay faster. So if it is going to medium to high, time value may maintain the persistency, and it may rise also a little bit. So this is the first conclusion we have got. Second, so which are the conditions which will invite this medium to high? If the prices are falling. If the prices are falling, then only it will invite the medium to high condition. If prices are going up, then the low volatility will maintain as low. Prices are going up, then low volatility is going to maintain low. So if the prices are falling, then only this volatility is going to go up. So whatever is going to happen in future, I am not bothered about that. I will be constantly following my current scenario. I do not know whether it will go to that thing or not. So that is, we cannot say what is going to happen in the future, but current scenario we must not ignore. So current it is low. We are saying that yes, it will maintain low. So maintaining low means the uptrend which has consolidated today may resume, and it may go in the uptrend. So for that reason, I have just formed a strategy here with delta neutral. So here I am just going to sell a future at 5911, and one put option I am selling because low volatility market, the 5,900 is the nearest strike, which is quoting at 75. I sold that one. So future is having a delta as 1. Hence I sold the future, so it will have a delta as -1. Buying a future must be having a delta as 1. Selling a future, I made it as a -1. Now 5,900 strike. Let us see 5,900 strike, and the put option we will choose here 24 days, and we are going to hold this trade for 10 days. So that is different thing. So now we are at 5911, and it is 75 rupees. It is quoting. Put option, analyze the price trend. So we got -4015 as the delta. -4015 is the delta. So I am expecting the low volatility will maintain low. So That means the price must be in the uptrend. Price must go up. So I have just sold a future and sold a put option. I have derived by these two process, my net delta is now here minus 1 added with minus 4.054, it is 1.40. By this process, my future is protected till 5911 added with 75. So I am protected till 5986. I sold a put option. So assuming, excuse me, that put option's entire money I am getting as a profit. So then my future will be profitable till 5986. If it moves beyond that, then I will be at a loss. So for that reason, I have taken a cover at 6000 call option. So 6000 call option, which is at a 47. So I have just derived the 6000 call option here, which is quoting at 47. I have taken a call option here, analyzing the price trend. So it is giving me 4062, 0.4062. This is the delta I have got. What does this delta says? Future is 100% risk. If I am buying a put option, then this is having a 0.40 risk, means 40% risk. If I am buying a call option, this too also a 40% risk. So here I have just sold a put option. So my delta I can reduce here. Instead of this thing, I have done a mistake here. Little bit of mistake I have done here. So this is my, I sold the put option, hence put option is a negative. So I sold, original delta was this one. So my net delta have become positive. And this is already I sold the future. So net delta is 0.5985. This is what the net delta is. Now 6000 call option is here, 4062. So we are going to form a delta neutral. So how many lots we should purchase so that this net delta must come down to a positive delta, and this must be L. This positive delta should be greater than 3%, only 3 to 30%, but 30% is too high. I do not want to take that 30%. So here what are the things we are going to do? So if I take two lots here, this multiplied with this 2, so then what will happen? My net delta will be this plus added with this one. So my net delta has come down to 0.21 positive. 0.21 positive, anticipating the upward price movement should continue. So let us see how much money got involved here. So here 47 into 2 lots into 50, so 4700. And how much I received here? 75 into 50. So I received 3750. Let me put a negative sign so that I can sum it off. So 3700 I have received from the sales proceeding. I am paid 4700 to the market. In fact, 11 rupees into minus 50. This too also time value I have associated with the strike and future price. Future price is 5911. So this 550 time value also I have added. So my risk capital I have reduced to 400 rupees. My risk capital I have reduced to 400 rupees. This says if Nifty goes up by 1%, which is now 5911 into 1 divided by 100. So if it goes up by 59 points from here, then this 400 rupees can appreciate by 21%. This 400 rupees will become 400 plus 84. So 400 plus 84. My money of 400 can appreciate to 484 rupees. Same way, if the Nifty fall down by 59, then my 400 also will reduce by 84. However, I have reduced the risk capital to 400 rupees. So if 21, instead of buying an option, instead of taking 3000, 4000 risk, I have reduced my risk to 400. Assume in a great case, if you are climbing to 6300, assume you are climbing to 6300. So what will be your losses and profitability? Let me calculate. So 5911. Assume you have gone in a very great way. So future you lost 389. 75 is a net gain. Put option you sold, so this 75 will be a net gain for you. So 300 minus 47. So this is per one lot. If it is going in a great way, if it is going up, then so into two lots you have, so you will make 506. So you can say net you will earn near about 192 points, and I can multiply with 50. 9,600 you can earn if Nifty goes to a very wild rally till 6,300. Assume Nifty fall down to 5,500. This is the best case scenario. Your profitability will go up with a risk capital of 400. Assume Nifty has fallen down to 5,500. You sold at 5,916, 5911, and you 5,500. It has fallen, so 400 rupees you made. 5,900, so 75, almost 400 rupees will be the time value. So 75 you received, so you can say 75 minus 400, so this much 325 rupees you will lose in the 5,900 put option, and this is again in the future, and the two lots of this thing, whatever you have taken 47 into 2, this will be also a losing component. So your loss is restricted to that maximum 400 rupees. So 8 point of losses in case of a wild fall, and in case of a great rise, your also profitability is going to increase in a great way. So this is what the benefit of the delta neutral strategy. You reduced the capital, so you reduced the capital, and you also brought it down, that risk of 40% to 21%. So you have also reduced the risk capital to 400 rupees instead of 4,000. You have reduced the, if you are a plain buyer of an option, you could have spent some near about 4,700 or 3,700. Instead of that, you have reduced the risk capital to 400. You have reduced the delta risk instead of 40% to 21%. So this process, you have protected yourself in a great way. However, without compromising with the profit, in case there is a great rally happens from now. In case of if the rally doesn't happen and it is going for a downtrend, then you must come out. So here I have already told you what is the downtrend price point. So here, if it is 5870 level, the initial stage it breaks, and further two levels it has broken successively, then you start closing the trade and come out. So I will not wait till the third level. Once it comes to 5870 level, rather I can close the trade, this trade, I can initiate the trade in a opposite order. Hence, I will buy a future, sell a call option, and I will buy some amount of put option, and I will derive the net delta to be negative. So as long as it has not broken the trend barrier point, I will stick to this trade and expecting a great earning from this trade. So this is what the delta neutral strategy. One simplest strategy. This is a covered put with multiple call option long strategy I have told you. Many other such strategies you can able to form. So many other strategies you can able to form. Almost 20 to 25,000 or 30,000 of the money you can keep in terms of your margin. So it won't take more than that. It won't take more than that. Once you go for the 4th December, you can think if Nifty validate the downtrend for 2 days and it come down as per the GAN principle explained by me in the previous lecture. So if it comes down to 5823 level, exit with loss. If it goes to 5987 level, book profit and come out. Your risk capital is maximum till 400. It is not going to be above 400. So do not worry about that. 400 is the risk capital you have taken. You can buy this tool. The tool pricing and other things I have already given here.